Welcome back, guys. This is a lesson on the idea of continuum of time and price. A continuum is something that keeps on going on. The markets have been going on for a number of years. But the traders have a very fragmented understanding or view of these markets. A person who is trading intraday, he's entirely focused on what is happening at that particular time, and he tends to overlook, or let's say not even take into account what had happened yesterday or day before yesterday. And it is applicable for even the positional traders who hold their position for very long. Even they tend to forget what has happened back in history, and it can give clues to the traders for their present trade. Now, this idea seems very difficult to comprehend at the beginning. How can one understand the entire picture? It's so big. There's so much that has happened, and uh, to an untrained person, this idea itself at the beginning is not worth probing into. But when you understand how the algorithm works and how it is designed to move, you will able to understand the story behind its move, the narrative that is guiding the price to where it is wanting to go. So just to illustrate this concept, I'm going to use one of my journal entries from January 22. Now, the reason I have chosen that is not because it is fitting exactly to the lessons that I have taught so far. It is just to uh, give you an opportunity to discover by yourself. When you go into the charts, I want you to get into the charts and make these observations by yourself, something which I have done for that particular week in January. I want you to go beyond it and start making those observations by yourself into your own charts, because that is where you will have the uh, firstly ability to recognize it, and then this is going to build up into making it easier for you to anticipate these things happening in future. So let's begin with the journal entry that I had made in January 22. This is the week beginning 24th of January, that was a Monday, till 28th of January, that was a Friday. Now, before explaining all that has been marked on the chart, I want you to first understand these three terms. I've been using it off and on without defining it precisely. I have defined the idea of a swing high and a swing low. And you all are aware that a swing high is a three candle pattern with one single high with two adjacent lower highs. And a swing low is one low with two adjacent higher lows. So the idea of these swing highs and swing lows has been explained, but the price swing per se from one swing high to the subsequent swing low, this movement is called as a price swing. I also use the word price range interchangeably. Price swing, price range, and dealing range, I use them interchangeably. So what they are is basically between one swing high and the subsequent swing low, there is one price range, or the dealing range, or it is a price swing. You can also notice that while the price started moving lower, there was a swing low that occurred in the price. So from this price point to this swing low is one price swing. Now this price swing can also be called as a price range or the dealing range. Thereafter, after this swing low, you have a swing high forming over here. So if I recalibrate this arrow to this swing high, after this swing high, you don't have any other swing high until a swing low is formed over here. There is no swing low in between as well. So from this high to this low, we can call it as a price swing or a dealing range or a price range. So this is something which I had not defined in my previous lectures. I had been using these three terms interchangeably, but I did not define it per se. So over here we have Monday's price range. On 24th of January, price traded down towards this low. As I said, every single day there is a price run towards one side of the market, and on that day the price ran towards the previous daily low that occurred on 4th of January 22. You can go back into your charts and have a look at this level. This is the exact low, that is 1.34602, that has been marked over here. And on 24th of January the price ran down towards this low. Now as I said, every liquidity run happens in grades of 10 pips, 20 pips and 30 pips. So on this day we find the previous daily low being run by 20 pips, 34602, and over here you have 34407. So approximately 20 pips, just short by a few pipettes. So here you can see that this low has occurred at 21:30 hours. Now whenever we consider a price swing, the way we understand that price swing is the top and bottom end. When you measure that and divide it by half, the bottom 50% is called as discount and the upper 50% is called as premium. Over here, when the liquidity run was occurring, we expect price to leave large range candles and run towards the liquidity faster. So this run creates certain imbalances in the price. The imbalance I had introduced to you as the fair value gap. That is when three continuous candles have one candle with no overlap between its body. So you have these three candles going straight downwards, and the middle candle has only a single body passing through this price range. So this is looked at as a imbalance by the algorithm. The algorithm would like to rebalance that price. It has to go back into this area. So this fair value gap was left open on 24th of January. On 25th of January, we find price going just below the previous daily low, that is 24th January's low, which had sell side liquidity below it, was absorbed at what time? 17:30. That's the beginning of our New York session. So you have sell side liquidity absorbed at 17:30 and price starts expanding higher. Now when you go down to 15-minute and 5-minute charts, you will find there will be a fair value gap in which this candle came down and then it ran upwards. So you would find a setup to trade in the New York session on the lower time frames. That I leave it to you to find it by yourself. Now this price expands higher towards what? The intraday high and internal range liquidity above it. So this fair value gap acted as the magnet for the price. to reach into. So on this day, the price would have started going higher and reach into this fair value gap. Now, on this day, this fair value gap is not completely filled, and the next day it makes an attempt to fill it completely, and this candle completely fills it. If you measure the pips from this high to the high of this fair value gap, you should not be surprised to find it equal to 30 pips. So this was a stop sweep above this high, 10, 20 and 30 pips. Once this fair value gap was completely filled, the price was allowed to continue going lower, and price moved from internal range liquidity to external range liquidity. External range. Now what is this range? It is this high to this low. If we consider this as the price range, on 25th of January, the external range liquidity was absorbed and price was taken into internal range liquidity. And from internal range liquidity, it again moved downwards to external range liquidity. If you remember, I said that on Thursday, generally we cap the weekly range by New York Open. So on 27th of January, the price created the low of the week, and if you see the time, it is at 18:30, that is the New York Open. So here, anyone who was trading on Monday or Tuesday or Wednesday, he wouldn't have understood the entire picture, but he would have been worried about where is the price going right now. Without having bookmarkers on these areas where price was headed towards, when the price moved from internal range liquidity, your eyes should go to the external range liquidity. That is where the algorithm is moving price. A similar example can be seen on Euro US dollar for the past week. I have not marked it as detailed as I have done on the pound US dollar chart, but over here you can see I have used the idea of price moving in multiple weeks. Over here it was just inside 1 week. Now in the euro, I have marked this particular fair value gap as the imbalance to which price would come. So in this week, now this imbalance has been left in the week beginning 23rd May 22. When the week started on 30th May and price started coming inwards, it was coming down into this imbalance. So the price was reaching towards this imbalance. So while it is reaching for this imbalance, it is also leaving certain imbalances. Just because it is moving faster towards these areas, this area remains as an imbalance. Now from here, once it starts going inwards, now the idea of price ranges have to be understood. These are dynamic in nature. See, you have a swing high over here and you have a swing low over here. So this is one single movement upwards with multiple swing highs and swing lows inside it. But the parent swing low and swing high is this. So when this low was breached over here on Wednesday 1st of June, this was the external range liquidity that got absorbed. So when the price is headed inwards, it is going into the internal range liquidity, and that internal range liquidity is over here, the imbalance that was left in price. So while it was reaching for this internal range liquidity, you also have a new price swing over here. This becomes the swing low and this becomes the swing high. Now when it turns lower from here, you have to see between this high and this low, where are the imbalances. The first one is over here, to which the price reaches into. Once this low has been broken downwards, you have to see where else is the imbalance, and you find it over here. So the price, once it has broken down from here, has to get into this imbalance. Once price turns upwards from here, you can see a very small imbalance left between these three candles over here, and now price comes down into it and expands higher. So over here what we are seeing is this swing low and this swing high. If this is the dealing range of price, then above this high is external range liquidity, and below this high and above this swing low is the internal range liquidity in form of this fair value gap. So price comes down into it, and from internal range liquidity it is going to external range liquidity above this high. But this external range liquidity is inside the this swing high and this swing low. So now you have price trading inside the range between this swing high and this swing low. This area is internal range liquidity, but between this low and this high, the price going outside over here is external range liquidity. So it is external to this price range but internal to this price range. So this context has to be understood. It looks very complicated at the beginning, but one has to understand what is the price range that we are trading in. Where can we find our entries and exits? So if I'm expecting price to go back into this imbalance, I would use this idea of break in market structure over here and return to a fair value gap as my entry, and expansion towards this imbalance. Now I will not expect price to go above this high, because there is an imbalance that price has to encounter before reaching this high. So this will act as a guiding principle for me to book my profits. This continuation of price moving from internal range to external range will be subjective. For this swing high and this swing low, this was internal range liquidity which was not completely filled. Price moved lower, but it did not make a new low below this. So this imbalance is still valid. It may be traded into. So when it started going higher on Thursday, the price went back and completely filled up this imbalance, and then it was allowed to trade lower below this swing low. Why? Because this swing low is now the external range liquidity. This was the internal range liquidity and this is the external range liquidity. So from here the price in a very swift manner moved below this low. Now why do you think it bounced from here? Go back to this imbalance. This imbalance begins at the high of this down candle, which is at 1.06106. If I have the price extended in future, you can see this candle's low as 1.06112. So from here the price bounced upwards. Observe, when the price on Wednesday had come down into this fair value gap, it had not completely filled up and this portion was left open. So on this Thursday the price went down into the entire imbalance bounced over there, and then it was allowed to move lower from this area. So this narrative, although looks very complicated as of now, once you see it happening day in and day out, you will understand the narrative behind the movement of price. The fragmented way of looking at price will be a hit and miss success for you. You will find that these setups, work sometimes for you and sometimes they don't. So the days when they don't, you should understand that you have not understood the correct narrative behind it. If you get the narrative properly, these setups will be stellar. They'll give you outstanding return for the risk you are taking on that trade. But on the days when you are on the offside, these setups will also help you limit your losses. Because if you are offside on this trade, like on this day, if you were wanting to buy at this place with your stop loss right below this low, would have saved, or let's say limited your loss, rather than keeping it open ended and having this kind of a move against you. It would take you out of the markets very soon if you don't have this setup understood well. So inherently, the setup that I have taught you is for your protection. It is protecting you against a very swift move against you that can lead to your account getting busted. But also, it puts you in a trade at a very precise point from where the run towards your profits is very, very swift. So that's all for the lesson for today. I want you all to go back into your charts and try to make such journal entries wherein you observe price going to an external range and coming back into the internal range, and from internal range to external range. When you understand this ebb and flow of price and you make these observations every single week or every single day, that is the time you will develop this capability of recognizing it first and then anticipating it to happen.